Hello? Hello? I mean, I don't know if we need these, but are we using them?
Video.
Oh, for the video? Aha. Hello? You can swap it. I change? Hello, hello? It's working? Okay. Well, guys, thank you very much for all joining and crowding in, and for those standing, we apologize that the room is so cozy. But welcome to this panel on impact investing. I'm really humbled to have here with us today a true group of luminaries in the impact space here in Israel. I'll introduce them all in a second, but just a tiny bit of background. My name is Richard Norman. I am co-head of the fund investing business at OurCrowd. As a lot of you probably heard this morning or may have seen before, OurCrowd recently launched its first impact fund. We did that in partnership with Social Finance Israel, who are here. And we're just super excited to be getting into the impact space in a much more formal, dedicated, thoughtful way. We've been making impact-like investments since inception, and it's been a long time coming for us to actually get involved in this way. And so we're very excited about it. And again, just very excited to share the stage with people who've really pioneered the space here in Israel. So by way of introduction, we have at the far end, VANESSA BARTRAM. VANESSA is a managing partner of Zora Ventures, which is a Tel Aviv-based impact investment fund focused on technologies here in Israel. Vanessa has a background in impact companies. She started a company called WorkSquare in Miami that went to $25 million in revenue. Came from the investment banking space before that, and has an MBA from Harvard, if I'm not mistaken, and a BA from Princeton. So there are smart people up here. Don't be shy.
Better than my mother. Thank you.
YARON, NEUDORFER, a partner and friend of ours, is the CEO of Social Finance Israel, which is really the leading impact advisory firm, I think, globally at this point. Yaron was telling me this morning that they've opened Netherlands and India last year. They already have the US, the UK, Israel, India, and you're opening Portugal, and you'll tell us all other parts of the world. Before Social Finance, Yaron spent 7 years as the CFO of the Jewish Agency, which is the largest nonprofit here in Israel, where he was responsible for a $400 million budget. Prior to that, he spent 12 years in the Ministry of Finance, working in the healthcare and education space, as well as being responsible for all of Israel's borrowing from Western Hemisphere countries. So the Israel bonds that I'm sure many of you are familiar with, that was under Yaron's purview. GRODECKI here is a managing partner and co-founder of Bridges Israel. Bridges Israel is part of the Bridges Impact Investment Network, another brainchild of Sir Ronald Cohen, whose name you'll probably hear a lot today. Bridges also have fund management businesses in the US and the UK, and Ron leads their Israel effort. He's got a 15-year career background in private equity investing, 8 years in management, executive management, 3 years in law, as an MBA from NYU, and it's a pleasure to have you here with us today. And Dalia Black on my right, last but not least, is a partner at DB Consult, where she serves as an advisor to families, to foundations, and to federations, helping them to create and implement impact investing strategies. And you'll hear a lot more about that today and its importance. But Dalia comes from the corporate world. Originally, she spent 10 years, most recently at DELIC, which is one of Israel's largest multinational corporations, as a VP in the capital markets team. Before that was at Vioda Credit here, which I think is a well-known name to many of you as an investment manager, and started her career at the consulting firm Accenture based in London. So it's really a team of seasoned impact thinkers, some of you investors, some of you advisors. And just before we get started, I wanted to ask, so that we will have kind of a working definition of impact, Yaron, I'll put the spotlight on you to maybe give us a definition that we can work with, and to the extent that anyone on the panel has any additions, modifications that they want to make to that, we can be on the same page and move forward from there.
Additions and suggestions. So there's too many definitions to impact, which is part of what challenging us. But the one I like the most, and I think this is, I suggest that this is the one that we use this morning here, is really made of 3 parts. Impact investment, first of all, it has to be an investment. An investment, you make money. It's not that you give up return in order to make your impact. You do well and do good at the same time. So it's an investment. It's not philanthropy of any kind. The second component is the intentionality. I think you have the impact is intentional. You plan it ahead. The same way that you do a business plan, you do an impact plan. And the same way you measure what you had in your business with the financial statements, you measure what you had in your impact plan. So the intentionality, it's not a byproduct. It's not by chance. You really mean and plan it. And of course, the third one, if you want to plan it and then measure it, we're talking about measurement. So you have to be able to measure your impact, measure and report about your impact. So I think the best definition that I know is it's an investment, it's intentional, and it's measurable.
Everyone comfortable with that?
We could care, yeah.
Yeah? Okay, so
We planned very good before.
exactly. The word itself, though, impact, I mean, it has a very, very broad scope that doesn't seem to necessarily at first glance capture those three concepts that you just mentioned and goes much, much beyond that. Do you find it's a helpful term in the market, or is it actually more of a hindrance because of that? Dalia, Vanessa, maybe?
Thanks, Richard. I think until a few years ago, people were a little bit obsessed with the definition of impact. So people would define as impact first invested, finance first invested. Is this working? Yes. But the market matured a lot in the last couple of years, and I think today it's less relevant, and people are picking their investments based on what works for them. So me, Dalia, on a personal level, I have my impact goals, I have my specific financial return goals, and I'm picking my investments based on my goals. So you don't hear so much anymore these more specific definitions of what type of investor you are. And maybe I can bring an example from the field. There was a lady in the UK called Diane Eisenberg. She had one of those bittersweet situations. Unfortunately, her father passed away. And the next day she found out that he was worth a few $100 million whilst they'd been living on a farm in Wales, if anyone's ever been to the UK. So she decided to stay living on the farm, and with the few $100 million, she turned it into an impact investment fund. And she has her goals, her impact goals, and every investment that comes their way, she decides if it's a high return investment, she puts it into one bucket, and if it's a low return investment for high risk, she puts it into another bucket. So I think what's important is that we follow, Yaron's definition, but that's it. It's like a very broad umbrella, and within that, what's important is that we do deals and we put money into the space and we develop it. And I think that freedom of being able to invest in any asset class, according to any mission, any type of return is much healthier for them. Because
Great. So then let's talk about what that investment then looks like. So when you're making an impact investment, how are the sort of due diligence criteria different on the impact side, or what are you thinking about that goes beyond what a financial investor would be focused on?
Sure. Brian Steinberg, I just want to introduce, he's in the back of the room, is our guru on deal sourcing. So he's sliced and diced the entire Israeli ecosystem to see what impact is for us and what meets our investment strategy, as Dalia was saying. But when we're looking at any particular deal, we're looking at particular problems to solve. We're looking at major challenges across hunger, health, environment, climate change, and looking globally at who are the best companies in the field that are tackling this solution. Fortunately, we think a lot of these companies that are going to win these challenges are in Israel, and that's why we're here in Israel investing in this. But we're looking, is the problem to solve significant enough? We're looking at the Sustainable Development Goals that Liad and Gila were here speaking about this morning, and using that as our framework for this is a problem that's significant enough for us to be excited about tackling. And even within the SDGs, for us personally as investors, there are some in there that we think are marginal, and some in there that we think are more important, and others that we think the Israeli ecosystem is particularly well positioned to be working on. So in addition to looking at what are the major problems to solve, we're then looking at this particular company, will they be able to move the needle in this solution? So with the financial projections that we're looking at, right there in our due diligence documents is a question of what is the main key performance indicator? What is the main impact goal that this company has year over year, so that we can be tracking that and measuring that, and helping them to better achieve it. And yeah, we want to make sure that it's a significant problem and that they actually have a solution that's going to move the needle on that.
So I agree completely, and I think to add, when we do a due diligence on the impact side, the unique aspect, I would say, when you do a financial and business due diligence, you touch upon the same probably same topics. It's a financial forecast at the end of the day. With impact, you have to define very clearly the impact thesis that the company is targeting. It's very different to look at a nursing home in the Eastern Galilee or a drip company that saves water across the world. So it's a completely different challenge from due diligence to due diligence, which I find fascinating. The other thing we are looking at are impact risks. So in some companies, for example, we have invested in a drip irrigation company, but then the question of do they use plastic that can be used again, reused, or is it going to be a risk? And if it is a risk, let's manage it. And the other element that we are very focused on is management. So are the entrepreneurs and the management aligned with the impact thesis, or are they just doing business, which is another topic?
So on that point, and Yaron included this in his definition, intentionality seems to be a very important pillar of what comprises an impact investment. But if you took your example of the nursing home in the Galilee, right, and the founder of that nursing home just realized that there's an incredible opportunity to start putting nice old ladies into homes in the Galilee because no one else is doing it, and yet from doing that, right, you've got all these elderly in great care in a wonderful facility, and he goes and spreads that into a whole chain of nursing homes, and it's incredibly profitable for him. It's clear that he didn't start out that business because he cared so much about helping, the elderly. He started that business because he saw an incredible investment opportunity, and yet so much good is coming out of it. So, are you going to say that doesn't work for me, and there's no intentionality there, or how do you reconcile that disconnect?
So, I believe that intentionality is important. As Yaron said, it's part of the idea, but the intentionality of the entrepreneur is not a must. It's a plus. It aligns the interest of the investor and the entrepreneur, but it's not a must. And what we talk about is a concept of lockstep. So if the business itself, when it grows, when it matures, creates more revenues, more profits, but at the same time, more positive impact, as the example of the nursing home, then even if the businessman is only there for profits, we will do the investment, but we will require agreeing with him on an impact plan, impact KPIs. We will demand measurement, reporting. So it is, as Yaron explained, it is completely managed. And it's not just a process, of volunteering in the afternoon. It's a core part of the business. But we prefer, obviously, entrepreneurs that are aligned also in their value proposition. So it's not a must, it's preferred.
I don't want to start a fight here, but you very kindly didn't modify Yaron's definition at all, but Yaron thinks that intentionality is a fundamental pillar of what it means to be an impact investor, and yet you're very comfortable investing when there isn't intentionality there at day one. Meaning intentionality is I started this business for a purpose, right? And so how does that get squared away?
I don't look at the entrepreneur himself, I look at the DNA of the company and at the service they deliver. So if the service itself creates positive impact by the nature of it, like the nursing home or like drip irrigation with significant water savings and increased yield and food security achievements, then the intentionality of the business is creating impact. Yes, the entrepreneur will make money, and hopefully our investors will make money at the same time, but it does not contradict.
Yaron, are you comfortable with that?
First of all, I'm comfortable.
That's a good start.
In the seat, or
In the seat. But you see, let's talk about the elephant in the room. It's a small room, not a big room for elephants, and yet. The elephant in the room is that the audience here thinks, okay, so what is impact? Is Teva generating or developing medications, drugs? Is it impact? They're doing good. There's no, we all agree about it. Is this considered to be an impact investment? If this is considered to be an impact investment, then probably most of the things that we do, apart from tobacco, arms, porn, gambling, some of you will not agree with me on certain
you said
parts.
most of the things that we do, you didn't mean it.
That's what I meant. So what is impact? And in that sense, and this is the risk. The risk is that it will become a wash. And if it becomes a wash, it will not hold. If we want it to be real, then let's have an intention about it. Now, I do agree with Ran that, and maybe this is the fine-tuning, that once they get into the investment, then they want it to be intentional. Before that, they look at the DNA of the company, but once you go in, then you have the intentionality. I think that's a good bridge for it.
I would add one thing. I think part of our role as impact investors is to help entrepreneurs articulate what they're trying to accomplish. So Sarah's here and working on the bee crisis and doing something amazing. We have another entrepreneur that approached us a few years ago and said they want to help forests, but there's a general inclination to do something good, but it's only going through that diligence process with them of mapping out, okay, how does your data analytics for satellite radar data product. This is a company called Planet Watchers in our portfolio, awesome company. How does that actually increase growth of forests, and how does that contribute to tons of carbon offset? So it's helping, as impact investors, I think we play a role in helping these entrepreneurs better articulate and line up what they're doing with the Sustainable Development Goals or whatever other framework they're using.
And maybe I'll ask you to help us with this before your comment. We've had a couple of mentions already of the Sustainable Development Goals. I think that it would helpful for the room to just have a better understanding of what those are and why impact investors are talking about them so much. Dalia, maybe do you want to give us a... No?
Give me the hard one. I think, no, just because my opinion on SDGs is that they're very important. Again, I'm very focused on doing deals. And SDGs are very important when you have a fund. So, Ran and Vanessa, I'm sure, can relate to that. And they're, traveling around the world and they're raising capital. And they've got to be very clear about what their fund stands for and what they're investing in and what the SDGs are within that. But a lot of the investors that I work with are families or foundations where the SDGs, they're important.
I'm just going to interrupt you. I want to maybe, and it doesn't have to be you, but so I want to explain to the room what the
SDGs are.
I think it's a bit of a wonky, industry term that not everybody is so familiar with.
I can go again.
I was going to say we have Liad here who just gave a seminar on it. So it's intimidating speaking before the expert. But it's basically a set of 17 development objectives put together by the United Nations originally in 2000 and renewed in 2015 with a goal looking to 2030. 17 objectives that, number 1 is no poverty. Number 2 is no hunger. 3 is health and well-being. And within these... No. That's only up to 3. I can count. So it actually sets out for corporates, for governments, for companies, what collectively as a planet are our goals and what are actually the quantifiable ways that we can make progress towards these goals so that everyone, no matter what tiny piece of the puzzle we're working on, that it's rolling up into a much larger progress.
Okay. And Dalia wants to attack them.
No, I don't. We have to add the Israel SDG experts.
Okay, fine. So I'll shift gears a little bit then. A lot of the conversation so far has been around business models, right? Like the purpose of the business to help the elderly to figure out drip irrigation issues that can have a very large sort of breadth and depth of impact on a societal scale. But there's another important tenet in the impact world on the governance side, right? Is just sort of how is the company behaving ethically? And that sometimes goes hand in hand with business model practices, but oftentimes doesn't, right? We can think about, responsible coffee shops or your shoemakers, and those aren't necessarily, I think, ones that we would think of as impact businesses, but nor do they need to be, but there is an element on the governance side. How important is that to you guys when you think about your investment, again, to take maybe the example of a nursing home in the Galilee, that there's governance on the impact side as well as sort of business model outcomes on the impact side? Vanessa, I know you're a B Corp champion, so maybe you want to share.
Listen, for us, it's extremely important. I think the field is evolving and at a really exciting place because the first time we're able to look at returns. Cambridge Associates has some great reports on this, tracking traditional PE venture capital funds against mainstream funds, also public equity funds against mainstream funds. And they're actually finding at this point that there's actually a bit more alpha in the impact funds. And I think the point is really this. Absolutely, we're investing in a company that's has a product or service that's doing something great in the world. But we also want to make sure that their governance structure is good, that they're treating employees well, that they're treating the environment well, that they're interacting and involved in their community in a positive way. And all of these things, I think what we're seeing, it's not just a good, nice to have. It actually creates that alpha because at the end of the day, they're not going to have the liability that other firms have and are increasingly being, called out for and held to task on the externalities that they're causing and previously weren't being addressed.
Yeah, and I think just to add, I think that the fact that impact investors and all other investors are looking more and more on what's called ESG parameters and creating a corrective plan through the due diligence process, and the company commits to take action after the investment and change its governance in the areas where there was a gap. In a pure investment sense, it's really management of risk, if you think about it. And even if returns are identical, but the risk improves, that's why the overall results of a portfolio, let's say ESG inclined portfolio, improves. So
and maybe one more aspect to it is not only the governance of the company, because it's intuitive, it's a risk mitigation tool, but the governance of the impact itself. And by that I mean specifically for funds, you do the investment and then you want to make sure that the entrepreneurs have a mission lock along the life of the investment, that the three entrepreneurs that are coming up with something, they don't really care originally about impact, not always. They care about exit. But you want, once you did the investment in this company, you want to make sure that they have a mission lock. The impact strategy remains along the life of the investment.
How do you go do that?
I mean, how do you do it?
They're going to still be focused on exit, right? And so if the opportunity to go partner with a large American, enterprise that has, instead of going out to Latin America and working with, underdeveloped or underserved populations is going to help them get to that exit quicker, you can put as much mission lock in as you want, but have you stopped them wanting to make money?
So first of all, I admit that the exit is a real challenge in the impact environment. And I'm not sure it's completely solved. But at least some of the impact funds, or impact investors, what they try to do is select properly. If you select a company, like the nursing home again as an example, where the lockstep is very clear, the more the company grows, the more it succeeds business-wise, the impact grows, even after you sold it, and we are a fund, we have to sell it eventually, in all probability it will continue in the same way. However, if I invest in, a small textile factory in the Arava, which is an amazing impact locally. But if it succeeds and grows to be very significant, I will have to push employment to, Bangladesh. Then the local impact is lost. So I'm seeing an impact risk here, and I might, through the impact due diligence, decide not to take this investment. Maybe it's good for a more business-oriented approach and not only for impact investment. So it really depends on the decision and day one. Still, there are situations where impact funds sell their businesses and the impact shifts a little bit away.
When you say the impact fund sells their businesses, to be clear, it's usually the entrepreneur selling their business, right? The fund...
Not only.
Yeah.
Bridges
Right.
Bridges in the UK usually takes control of companies, develop the companies, and after 5, 7, 9 years, whatever, sells it, and then the new owner may be inclined to continue with the same approach, but sometimes it shifts.
Okay, so that's more of a private equity model than a venture capital.
I just wanted to touch on we haven't actually mentioned the entrepreneur. So, when it comes to impact lock or impact to exit, at the end of the day, the responsibility is on the entrepreneur, not on the investor. No matter what we will do, if the entrepreneur is committed, then the exit will be through an impact manner. They will be choosing the right type of investors. Entrepreneurs, and we've got a few of them in the room, Talia at the back, for example, they choose their investors really, really carefully. And instead of choosing, a Chinese VC fund that isn't interested in impact at all, they'll work really hard to find an impact-focused investor. And I think that is the only way to ensure that there is a real impact-focused exit at the end of the day.
Okay, and helpful. So it sounds like the investor here has the opportunity to be an influencer, but not necessarily a final arbiter, which makes sense. So when you get in, maybe some of the investors and advisors could talk a little bit about what are the types of positive steps you can make to actually drum in this message of mission lock, to actually get people more excited about impact? How do you sell the entrepreneurs on that?
So I think it really depends on the company, and so far we have made 4 investments, and all investments are in companies where the entrepreneurs are very impact oriented. So in a way, it's a much easier job, but still you have to refine and adjust the impact model and focus it together with the management and agree ahead of the investment on an impact plan that the entrepreneurs bought into. And once they do, then there is an actual measurement reporting. Some of the companies we invested in even nominated a head of impact internally. And I would recommend to companies to approach YARON, for example, after the investment, and nominate him as a consultant to monitor the company's impact measurement parameters, because you need someone from the field that knows the ins and outs of the impacts to align a whole company and create a DNA there. So I think advisors has a very crucial role in developing this going forward.
Dalia, you agree with that? Good. That was easy.
You need to make more cases where you can prove that impact strategy or impact KPIs help the business grow, help the business succeed. And I don't think we have it yet. I mean, for investors, foreign investment is great, but you can use
just a start.
no, but you can use the experience of Bridges UK to prove this exact cases where impact KPIs really drive the business for better success. And there are many cases where you align, as I said earlier, when you align doing good with doing well, and you still do well, but you need to show it.
Maybe I'll just give one example, as Yaron suggested. Bridges in the UK invested in a rundown building in one of the worst neighborhoods in London, like 12, 15 years ago, and built something called the Hoxton Hotel. They went to a very environmental and green concept.
It's a very hot place in London right now.
Now,
Yeah.
but it was really a rundown area, and they really positioned and branded the hotel as a very green, environmental friendly, and it was quite unique at the time. And because of that, it captured a lot of attention and huge retention rates and recurring customers. And because they insisted on impact on the local SMEs, the whole neighborhood thrived. And eventually, because of the impact, there was a big business success, and they sold the hotel at a 9-time multiple on their investment, which is an amazing investment example.
So that brings up a very interesting point, which is, they made a business decision, which seems like it was also very guided by where consumer sentiment is, right? They kind of knew that a hotel position like that was going to attract a ton of customers, and there probably weren't many of those in the market today. And so, how much has consumer sentiment around responsibility changed in recent years? And how much does that help what you guys are doing? What are the confluence of events, I guess, that have created this impact market today, and what are the biggest drivers of it?
There's a group here in Israel which is called 2B. There isn't a representative of them here today, but the major investor there is a gentleman called YARON, a very well-known Israeli family, and his whole life, goal is what we call conscious capitalism, which is basically to do exactly what Richard has just explained to us, which is to give the consumer the responsibility to be only buying goods which are not causing any damage to the environment or to society or governance. And it's a growing trend. I would say it's, at least in Israel, it's very, it's really in its nascent stages. Perhaps in the US, it's more developed than in the UK, but it's definitely a growing trend. If you look at conscious capitalism, there's a global organization by that name, and it's very interesting. And he has what's called the social TAV, it's like a certificate. And his goal is that every consumer product in Israel will have this certificate, and you'll be able to judge as a consumer whether to buy or not to buy that product. So I think it exists. It's really nascent, but it's a trend that will probably grow in the coming years.
And I want to talk about it from a slightly different angle. How many of you in the crowd, in the audience, have pension plans? Probably all of you, right? I hope.
I didn't see a lot of hands go up. I don't know what's happening in this.
How
Our
many
crowd's
of
pension
you?
business is
How
starting
many of
tomorrow.
you know what is the annual return on your pension plan? Less. Nobody. How many of you know what is your pension scheme investing in? Which companies? What is the strategy? What is the policy? Do they have an impact policy? Do they have a governance policy? So that's another side of consumer will. And if we all go to our pension funds, where the big money is, the institutional investors, pension funds, insurance companies, provident funds, and we tell them, listen, we want you to invest responsibly. We don't ask you to lose our money. No, that's not what I'm saying. We don't ask you to compromise on return. No. But once we set the agreement in the room that you can make money and impact at the same time, we want you to invest our money in things that do good, or at least not invest in things that do harm. So this is the real power, the real consumer power, and we can do it today. And that's where the big money will flow into impact. Because we are now doing small stuff. We think it's big. It's still small. But that's where the big money is. That's the big opportunity.
Just to touch on Yaron's concept, in France, for example, in some of the pension fund schemes, the saver, the consumer in a way, he can check a box if he wants 7% of his pension to be invested in impact-oriented, let's call it for this discussion. And if you take the amounts of pension money and take 7% out of it, we are not even moving the needle compared to the potential.
This is when Yaron and I sing a duet. One thing I'd say I think is really unique about the Israel space, and that I see relative to, Silicon Valley. So many of the startups here the founders are technologists, are researchers, and they're designing technologies that are for B2B applications. So they're looking how to help companies around the world do what they're doing more environmentally friendly, more healthy, because we're such a small country and we're far away from a lot of the markets that we're selling in. That B2C and the sort of consumer focused is not necessarily our specialty. But I think we actually, for such a tiny place, have far more opportunity for impact at that B2B level. So those are the types of, companies that we're looking at. So the consumer facing is sort of one step removed. But I think, you look at a lot of the impact companies in Silicon Valley, and it's consumer facing products, a lot of them CPG, which, maybe fickle audiences and quickly changing trends. And we have opportunity in Israel to really, have disproportionate impact because of our focus.
Very interesting. I want to continue on sort of different stakeholders' perspectives. We've touched sort of entrepreneurs, investors, consumers. From the foundation side, impact is it's an interesting premise, right? Because there needs to be somewhat of a sea change to convince investors that they should be doing good with their money, because that's not historically what's happened. But foundations, who are some of the largest capital providers in impact today, have always had the intended goal of doing good with their money. And so, to go up to a foundation and say, you should think about impact investing. If impact investing is do good with my money and preserve my capital and maybe make a return on it, aren't they kind of like, yeah, I've been doing that forever? Like, what is it from their perspective? Is impact different today than how they thought about how to allocate capital 10 years ago? Or is it really just dressed up in a different name?
So interestingly, it's the foundation world that coined the term impact investing. So 20 years ago, a small unknown foundation called the Rockefeller Foundation in 2007 actually coined impact investing. And that's where it was born. And I would go as far to say, as the whole impact investing sector exists and thrives because of the risks that the foundation world have taken in this space. So, of course, the goal of foundations, any philanthropist, is to create social impact. But until 20 years ago, you were making minus 100% on your investment, right? You know, everyone was giving a grant and not expecting anything in return. And I think that the change in the last 20 years for the foundation space is huge. I mean, think about professionals. They were trained and know how to give a grant. And now we're saying, okay, well, now we don't want you to just give grants. We want you to also make sometimes very complicated investment decisions, you know, Bridges or Zora, private equity funds. So the change has been huge. And I think that the foundations who've embraced it have enabled the sector to totally take off, especially foundations like MacArthur or like Leichtag, who are very focused on Jerusalem, for example, that are 100% invested their endowment according to an impact lens. So I think that foundations are, of course, impact focused, but they've now found a model which is way more scalable, way more leverageable. Okay, you put $1 in, you can get it back and give it again, you know, 10 times over. It's hugely engaging for a second generation, hugely. And, you know, you look at these endowments, which are billions of dollars in size, and they can now also be invested according to the values of the family who own the endowment. So impact investment has given the philanthropic foundation world a huge ability to do much, much more to get to their impact.
And one more aspect to this is that today foundations, you know, 50, 60 years ago, for example, American Jewelry, many people in the room belong to this sector, would give the check to people in Israel and say, you guys in Zion, you know what you need to do with the money. Now they wanted to focus on outcomes. And impact investing, and I go back to measurement, enables you to measure outcomes. Not only inputs or outputs, but real outcomes. And if you focus on outcomes, it makes your philanthropy more precise, and it makes your whole investment strategy support your philanthropic goal. So that's another important aspect that drives the foundation world into impact investment.
Okay, so maybe the last large stakeholder that we haven't really spent much time on today, who definitely, you know, struggle on outcomes often, is government, right? And government should be more excited than anybody about the potential of impact, because the potential to offset public sector costs from what is happening from these entrepreneurs, these foundations, etc., they're massive saving to government where resources can then be deployed in other places. So, but one of the challenges of government getting involved in any innovation endeavor is that they're not good at it, right? And they're fickle and they change quickly, and we see this across markets. And so when you think about the government role today in impact, how do you ensure that, you know, they're used correctly? And, you know, maybe for the advisory side, or Ron, even though.
I just want to give an example of a government intervention that I was involved with, which was very successful from the eyes of the government. I've managed a firm called Bereshit, which is a Mano fund. It's a 2 billion shekel fund, which was really initiated by the government, by the Ministry of Finance in 2008 on the back of the financial crisis, where there was a liquidity risk in the financial markets and companies who raised bonds, where there was a fear they will not be able to, take new debt to repay the old one. So they came out and said, okay, we will be an investor, 500 million shekel investor, and we will give any institutional investor a 4% floor of returns. And what was amazing is that once they did that, on a theoretical liquidity issue, which is, I think, much less important compared to the impact benefits, we were able to raise 1.5 billion shekels from institutional investors into this fund. And so you immediately had 2 billion shekels in the market contributing. So think about the government doing the same thing on the impact side. It could be amazing, and I know as a fact that once you give institutions a floor, they will come and they have so much money they don't know what even to do with. And I think in Bereshit's example, the government not only didn't lose money, they made 200 million shekels profit. So it's, I think, a win-win case, and I think our responsibility, which is a very significant one because we're very small and very young, is to show these stakeholders that money can be made, and then governments and institutions will come into this space, I think, with a much heavier commitment.
But governments hate to give a floor or first loss or downside protection. And what they do like is to shift risk. They do like tax, right? That's right. But they like to shift risk. And one of the most successful ways to shift risk from taxpayers to investors, by the way, is the pay for success projects, or what we call social impact bonds, where you raise money from investors to fund a very clear and focused social intervention on a specific project. It can be a prevention of diabetes, reduction of dropout rates from higher education, et cetera, and then government pays back investors according to the level of social outcomes that were achieved. So the more social outcomes, and it's predefined, everything is predefined and clearly measurable, according to the level of social outcomes, that's the level of return to investors. Why would government want to do that? Because it generates economic benefits to government, either savings or increase in revenue in case of employment and tax payment. So that's another tool that is becoming more and more popular. We just launched our third social impact bond, focused on enhancing math studies to the most disadvantaged population in Israel, Bedouin community. And government, specifically Ministry of Education, will pay back investors according to the number of Bedouin kids that will matriculate from high school with the highest level of math. And that's not about education. It's about giving them life opportunities for better employment. So, and it's also a policy tool, because government will change now, but this agreement will remain because there are investors at the end. So it's a great policy tool.
That's good. That's good. Okay, guys, we have less than 30 seconds left, so I just want to wrap up and say thank you very, very much. The ecosystem here today is too small, but I think it's growing, and it's growing in large part because of the work that everyone on this panel has been doing and continues to do. So we have a ton of respect for the work that you guys have done so far, and excited that OurCrowd is finally in the impact space in a more formal way, and looking forward to working with all of you in the future. So thank you.
Thank you very much.
Thank you.